Hi, folks, and welcome back to this month's Foguth Financial Group Client Connection. I'm Michael Foguth, and this month we're tackling the topic that's both close to the heart and surprisingly technical. Folks, charitable giving. I'm telling you what an amazing topic. Most people give back because they care, but very few realize just how many strategic ways there are to do it. Here to walk us through is Rhoda Woods, a certified financial planner here at Foguth Financial Group. In this first segment, she'll uncover the strategies that you can put to work during your entire lifetime. Rhoda, take it away.
Thanks, Mike. As he stated, I'm Rhoda Woods, a CFP and accredited portfolio management advisor here at our Foguth Financial Group Farmington Hills office. And I'm here to talk to you about creating win-win through charitable giving. Wins for you and wins for the organizations you believe in. Maybe you support a local youth outreach, or you give to your church. Maybe it's an animal rescue or your alma mater. If so, you're in good company. Millions of Americans support great causes each year, and not only that, our federal government believes charitable organizations play such a crucial role in our society that they've created preferential tax incentives to reward people who are charitably inclined. Those incentives allow for reducing current income taxes and reducing the size of your taxable estate. Now, before we highlight some specific strategies, it's important to understand how changes in the standard deduction have impacted charitable giving incentives. From 2017 to 2018, the Tax Cuts and Jobs Act raised the standard deduction from $6,350 to $12,000, pretty much doubling it. And it's continued to increase every year since. This change has drastically reduced the number of Americans who derive any benefit from itemizing on their taxes, which is where they could write off charitable contributions in the past. Now, the new tax code will allow you to write off charitable contributions without itemizing, but only up to $1,000 for an individual or $2,000 for a married couple. A word of caution: before you donate, be certain the recipient is a qualifying organization. All nonprofits are not created equal, so you need to make sure it's also eligible to receive your tax-deductible contributions. Qualifying organizations will include most religious and educational institutions and those with the official 501c3 designation. You can verify tax-exempt status using the IRS Tax Exempt Organization search tool found at irs.gov. Now, let's look at various ways doing good for others can also benefit you and your family. First, let's talk about donating highly appreciated stock from taxable accounts. Now, you can only use this strategy if you itemize on your taxes. What is highly appreciated stock? Simply, it's when your stock is worth a lot more now than it was when you bought it. Say you have $100,000 of highly appreciated stock to donate. If you sell it and donate the proceeds, you may have to pay capital gains taxes on your profits first. So what started out as a $100,000 donation could end up being $15,000 or $20,000 less. If you transferred the stock directly, the charity will get the full benefit of the $100,000. It's also a win for you because now you've eliminated the capital gains tax you would have had to pay, and you can claim a charitable deduction at full current market value. The second strategy involves taxable accounts holding stocks that have decreased in value. Say you purchased a security for $100, but it's lost value and now it's only worth $70. This is where, instead of donating the stock directly, you sell it and donate the proceeds to charity, allowing you to not only claim the charitable deduction, but also using the loss incurred to offset earned income, which reduces your overall taxable income for the year. This process is called netting capital gains and losses. And if your losses exceed the claimable amount, you won't lose them. Next up, Qualified Charitable Distributions, or QCDs, for seniors. Now, you have to be 70 and a half to use them, but the great thing about this strategy is you don't have to itemize in order to apply it. Qualified Charitable Distributions allow you to take advantage of the associated tax breaks while using the standard deduction. So how do they work? With QCDs, you make your charitable contribution directly from your IRA. Retirement accounts still with employer retirement plans, such as 401ks, are not eligible for QCDs. That could be another great reason to execute an IRA rollover when you retire. Now, when you itemize, the contribution amount is included in your income and then you deduct it later. With QCDs, they never count toward income, so it lowers your adjusted gross income, which is used to determine your eligibility for even other tax savings. Another huge benefit is that once you start taking required minimum distributions, you can take a qualified charitable distribution in place of your RMD, and you won't have to pay taxes on it. Our next technique is consolidating deductible expenses, commonly referred to as bunching. Bunching provides an opportunity to take advantage of both the standard and itemized deductions. If we look at the items eligible for itemizing, like charitable contributions, through a 2-year lens where we consolidate 2 years worth of those items into 1 year. This allows us to itemize 1 year and take the standard deduction the next.
We'll come right back to you, Rhoda, in just a moment. But first, we've got some exciting news to share. A brand new partnership we could not be more proud of. Take a look. At Foguth Financial Group, education has always been at the heart of what we do. And through our new partnership with Eastern Michigan Athletics, we have the opportunity to bring that mission to an even bigger stage. From student athletes and coaches to staff, alumni, families, and fans, we're here to educate, connect, and support the people who make EMU special. This partnership goes beyond one field, one court, or one season. Foguth Financial Group is proud to be all in with EMU. We're just getting started. Well, so far, Rhoda has shown us ways to give smarter while you're still living. These are strategies that you can turn into generosity for a legacy that lives well beyond you. Rhoda, back to you.
These final two strategies are about making a lasting impact and establishing how you want to be remembered. An easy way to do that is through beneficiary designations. You can name a charity as a sole or primary beneficiary of an account or policy. For example, you may take out a life insurance policy and name the charity as the beneficiary. Or maybe you have a brokerage account where the charity gets 10% and your kids split the remaining 90%. By the way, tax-deferred retirement dollars are best suited for charitable giving, while taxable accounts are best suited to be inherited by loved ones. Why? The charity doesn't have to pay taxes on what is donated from a tax-deferred account, but your children would. However, if the kids inherit a taxable account, they get the benefit of what's called a step up in basis, where they won't have to pay taxes on your capital gains. Their tax counter restarts at 0 on the day they inherit the account and goes up or down from there. The last strategy I'll mention is gift planning using charitable trusts. These types of trusts are funded through irrevocable donations that remove assets from your taxable estate. Charitable trusts fall into two broad categories: charitable lead trusts and charitable remainder trusts. With charitable lead trusts, the charity is the beneficiary of the income generated by the trust, either for the life of the donor or for the life of someone the donor specifies, or for a specified period of time. After that, the remaining principal, or what's called corpus, goes to a non-charitable beneficiary, such as the donor's children. With charitable remainder trusts, the non-charitable entity, like the donor or the persons they specify, receives income from the trust either for life or for a period of time. After that time has elapsed, the charity inherits what remains. But as I wrap up, hopefully I've given you a few things to think about and maybe some conversation starters. Please know you don't have to process and figure this all out on your own. Your Foguth advisor is here to help. So if you want more information on the right charitable giving strategies for you and your family, reach out. Again, I'm Rhoda Woods, and thank you for tuning in.
Here's what I want you to take away from today. Generosity and smart planning aren't at odds. In fact, done right, they should go hand in hand. The right strategy can mean more going to the causes that you love, the people you love, and a smaller tax bill that lasts for a legacy for both you, your family, and your community. But as Rhoda said, you don't have to figure this all out on your own. Every situation is different, and the right approach depends on your accounts, your goals, the causes that are closest to your heart, and how you want to show up beyond your lifetime. If charitable giving is part of your plan, or you'd like to learn more about it, all you have to do is reach out to your Foguth Financial Group advisor and tell them, let's start building this legacy together, whatever is right fit for you. Folks, thanks so much for joining this month's Foguth Financial Group Client Connections. We'll see you all next month.